Okay, let's get right into it. We are standing at a pivotal moment in history. The year is 2026, and everyone is asking the exact same question. Is this AI revolution about to launch us into a golden age of prosperity, or are we staring down the barrel of a massive economic bust? Honestly, the stakes have never been higher. So, let's set the stage. The date is February 17th, 2026. Right now, the global financial markets are teetering on a knife's edge. On one side, you've got this incredible, world-changing promise of technology. And on the other, a deep, nagging sense of economic fragility. And this really is the multi-trillion-dollar question, isn't it? Is all this money pouring into AI fueling a genuine productivity miracle like we saw in the 90s? Or is it just inflating a bubble of epic proportions? Well, as you're about to see, the answer is anything but simple. To really get our heads around this, here's how we're going to break it down. We'll start with the big picture idea of a great bifurcation. Then we'll look at the colliding market cycles and the wild mood swings they're causing. We'll dive into the strange paradox happening in AI hardware versus software, explore 3 possible scenarios for the rest of the year, see who the global winners and losers are, and wrap up with a clear strategy. Let's do this. All right, first up is this core idea that frames our entire analysis, a great bifurcation. And believe me, this isn't just another buzzword for a market shift. We're talking about a fundamental split in the economy, driven by some seriously powerful forces crashing into each other. So what exactly is this great bifurcation? Well, picture this. You've got these huge, predictable, long-term economic cycles that have been ticking along for decades. And suddenly, they smash head-on into the completely unpredictable, game-changing force of agentic AI. And we're not just talking about AI that helps you write an email. We mean AI that can act on its own autonomously to get things done. It's a collision of epic proportions. Now, to really grasp what this collision means, we have to understand these deep rhythms of the market. These are historical patterns that suggest things might be a whole lot more fragile than they look on the surface right now. And our guide for this part is the incredible work of an economist named Edward R. Dewey. This guy spent his entire life showing that huge market events often aren't random at all. Instead, they move in these predictable, repeating cycles. And right now, it looks like 2 of his most important cycles are lining up perfectly. And that might not be a good thing. The first one is the big one, the 18.2-year real estate and credit cycle. This pattern has been unbelievably accurate, pinpointing everything from the Great Depression to the 2008 financial crisis. And according to Dewey's work, we are right at the tippy top of this cycle, a peak that's being supercharged by the insane global investment in land and buildings for all these new AI data centers. But wait, there's more. Layered right on top of that is the 9.2-year stock market cycle. And what this cycle suggests is that the market is scheduled for a major turning point later this year, sometime around August. So you see the problem, right? When you have these 2 massive cycles peaking at the same time, it creates this period of extreme vulnerability, where any little shock could set off a chain reaction. And what's so fascinating is how you can literally feel this tension in the air. It's a tale of 2 completely different moods. On one side, you have the wild optimism of Silicon Valley and policymakers. I mean, the San Francisco Fed president is out there saying this is just like the 90s productivity boom all over again. But on the other side, there's real fear brewing on Main Street. Over 24,000 tech workers lost their jobs just last month as companies start replacing them with agentic AI. This kind of extreme split in social mood, well, it's a classic warning sign of major instability ahead. And that brings us to the paradox that's right at the heart of the entire AI industry. It's really a story of 2 different markets moving in opposite directions. One is booming like we've never seen before, and the other is staring at a potential existential crisis. First, let's talk about the hardware supercycle. The demand for NVIDIA's next-gen Vera Rubin AI platform is just astronomical. And it all comes down to a single, tiny component, HBM4 memory. A flat-out war is being fought over this stuff. SK Hynix is the king right now, totally dominating the market. But Samsung is making a huge comeback, and they've just started shipping their own chips. And then there's Micron, trying desperately to convince everyone they're still in the game. This right here is the new gold rush. But then, you have the other side of this paradox. Just recently, an agentic AI tool from Anthropic was launched, and it caused $285 billion to be wiped off the value of software stocks in one day. One. So you have to ask yourself, how is it possible that AI can be creating so much wealth in hardware while simultaneously destroying so much in software? Well, the answer is something people are calling the SaaSpocalypse. You see, for decades, software companies made their money with a simple model. They charged a fee for every single employee who used their product. It was called the per-seat model. But agentic AI completely shatters that model. I mean, why would you pay for 100 software licenses when one single AI agent can do the work of 100 people? It's a fundamental change that's turning the whole industry upside down. So with all this conflict, colliding cycles, clashing moods, hardware booming while software is busting, where do we go from here? Well, let's take a look at the 3 most likely scenarios for the rest of 2026. This chart pretty much says it all about the level of uncertainty we're facing. Okay, so there's a 25% chance of a productivity melt-up. This is the dream scenario, right? AI drives massive growth and inflation stays low. Then there's a 35% chance of a soft landing, where things kind of balance out and the market just cools off. But the most likely outcome, sitting at 40% probability, is a stagflationary collapse. And that is the absolute nightmare scenario. AI disrupts millions of jobs, which kills consumer demand, while the massive energy needed for all those data centers drives up inflation. Ouch. Now, this whole bifurcation thing isn't just a theory on a chart. It is actively creating a world of clear winners and clear losers all across the globe. Let's take a quick tour and see how this is actually playing out. In the United States, what we're seeing is a K-shaped economy. Think about the letter K. The top arm is shooting up. That's the AI, hardware, energy, and infrastructure sectors. They're booming. But the bottom leg is pointing straight down. That's the traditional software and service industries that are getting hammered. This kind of split could push a lot of investors into the safety of U.S. Treasury bonds, even while parts of the stock market are in a freefall. Now, who's a clear winner in all of this? Look no further than South Korea. Because of Samsung and SK Hynix's total dominance in that critical HBM4 memory market, the country is basically turning into the world's AI armory. Some analysts think this could send their main stock index, the KOSPI, soaring towards the 6,000 mark. And all those exports would likely make their currency, the Korean won, much stronger against the US dollar. And you absolutely have to keep an eye on China and Hong Kong. We could see a major rebound there, potentially sparked by a combination of strong government stimulus and that big meeting plan between President Trump and President Xi in April. A deal there could really ease trade tensions. Meanwhile, Europe and the UK seem to be stuck in the middle. They don't have the hardware giants of Asia or the big AI leaders of the US. So their markets are getting all of the pain from the SaaSpocalypse without a lot of the upside. This could mean their stocks underperform, and the euro and British pound could get weaker against the dollar. So here are the key dates to circle on your calendar. Coming up in March, NVIDIA officially pulls the curtain back on its Vera Rubin platform. Then in April, we have that massive Trump-Xi summit. And then in August, that's when we hit the inflection point for Dewey's 9.2-year stock market cycle. That could be when the real fireworks begin. Okay, so how in the world do you navigate a market that is so full of contradictions, so full of risk? Well, this last section is all about a clear, actionable strategy. The approach that many are recommending is called the barbell strategy. Think of it like this. On one end of the barbell, you attack. You invest in the things that are the backbone of the AI boom, the HBM4 suppliers, the power companies, the copper producers. On the other end, you defend. You hedge with hard assets, things like cash, gold, and Bitcoin. In between, you might even consider a short position against those old-school software companies that are most at risk. And finally, number 4, you protect your whole portfolio by getting ready for a big spike in volatility as we head into the third quarter. You know, when you put it all together, maybe the best way to think about 2026 is this quote. The AI party is absolutely in full swing, and the music is playing loud. But with so many historical cycles pointing to a massive change on the horizon, the smartest strategy might just be to keep on dancing, but always, always stay close to the exit. So what do you think happens next?